Have you noticed a sudden change in the produce aisle lately? In several regions, popular Moroccan and Turkish mandarins have completely disappeared from the market. Is this a supply chain crisis, or is a major season just hitting its final stretch? Today, we are diving into a massive shift in the global fruit trade. From shrinking availability to a high-stakes origin power play, the landscape of your grocery store is changing faster than you think. Let's find out what's really going on behind the scenes of the market.
All right, welcome to this week's briefing. We're seeing a really big shift happening right now across the European produce market, and we're going to break it all down for you.
So here's what's on our radar today. We've got three major stories playing out. First, this massive strategic pivot towards fruit from the Southern Hemisphere. Then, we'll look at some serious price friction heating up in the vegetable aisles. And finally, our main event, a deep dive into what's happening with mandarins as their season winds down.
Okay, so first things first, let's zoom out and get the big picture of the market. You really need to see the whole board to understand what's happening with the individual pieces. So when you look at the fruit category, there's a definite geographical shift underway. Apples, they're holding steady, pretty much anchored by the usual domestic and Italian stuff. But the real action, the story to watch, is in pears and grapes. We're seeing South African pears come in strong, pushing out the Italian supply pretty quickly. And their grapes, wow, they are just setting the pace for the entire market, with a little help from Peru and Namibia.
Okay, now let's switch over to veggies, because things are getting, well, a little tense over there. You've got new cucumbers and peppers from the Netherlands and Belgium hitting the market, and they are coming in hot. All this new supply is putting some serious downward pressure on prices, especially for the Spanish growers who were there first. It's sparking some pretty heavy discounts. Basically, a real fight for shelf space.
All right, that brings us to our main case study this week. It's a perfect example of these end-of-season pressures we're talking about. Let's zoom right in on the Mandarin market.
So there's no question about it. The Mandarin season is on its last legs. And that means we're facing three big challenges. First, there's just less fruit available. Volumes are dropping everywhere. Second, the quality is starting to get a bit hit or miss, and that's making buyers really picky. And third, demand itself is cooling off. People are only buying what they absolutely need right now.
And this chart, it just lays out the power dynamic perfectly. You can see Spain as the volume king, right? Holding down over a third of the market. But here's the interesting part. Look at Israel. They've carved out this huge premium spot for themselves with about 30%. Meanwhile, Morocco and Turkey, who used to make up almost another third of the market combined, are pretty much packing up and heading home for the season.
Okay, let's break this down even further with the power matrix. So Spain's Nadorcott and Tangold, think of those as the workhorses, the volume backbone of the market right now. But the star of the show, the premium player? That's Israel's Orri. It's got that superior taste and aroma, what we call organoleptic properties, and that's what's driving the high demand. At the other end of the spectrum, you have Egypt's Murcott finding its place as the go-to budget option.
And this isn't just numbers on a screen, It's what people are actually seeing in the markets. The report literally says that Moroccan and Turkish mandarins have just vanished from some areas. So the takeaway here is huge. The suppliers who were running the show just a few weeks ago, they're now bowing out. So let's get specific. Who are these new champs? We're talking about Spain pushing out these awesome late-season varieties like Nadorcott and Tangold. And then you've got Israel with its famous premium Orri mandarin, the one that's incredibly sweet and peels like a dream. They're basically swooping in to fill the gap that Morocco and Turkey left behind as their seasons wrapped up.
And here's where the rubber really meets the road. The price. This is what that quality difference actually looks like in euros. Israeli Orri is commanding a whopping 248 euros per 100 kilos. Just think about that. That's a nearly 30% price premium over what Spain is getting for its volume. It's a textbook case, really. When a market starts to shrink, premium quality is what holds its value.
The whole story is right here in this one chart from week 12. Let's dig in.
So who's at the very top of the ladder? That would be Israel.
They're fetching a massive 248 euros per 100 kilos, a real premium price.
Okay, next rung down the ladder is Spain, and they're the biggest player in the game.
Their price, 191 euros. That's kind of the benchmark for the whole market, right?
All right, let's look at the middle of the pack now, the mid-tier competitors.
You've got Morocco coming in at 150 euros, with Turkey just a bit lower at 120.
And then, at the very bottom of the ladder, we find Egypt.
Their mandarins hold down the lowest price point, coming in at just 118 euros.
Okay, so we've looked at all the data. The big question is, what does this actually mean for you? How do you play this in the coming week? From where I'm sitting, there are 3 clear moves to make. First, if you can, lock down whatever Israeli Orri you can get your hands on. It's the one variety that still has total consumer trust. Second, you can use the Egyptian Murcott to keep an entry-level option on the shelf while everything else disappears. But the big one, the most important one, is to get ready for the pivot. It's time to speed up that transition over to the new South African pear and grape harvests. That's where the demand is headed. So, that leaves us with one final, really important question for you and your team. We know the citrus window is closing fast. The market is making a hard pivot away from Mediterranean citrus and looking south. The question you have to ask is your supply chain ready to make that pivot with it?
Welcome to the debate. So back in mid-March, Moroccan mandarins were, a staple on the European fruit market.
Oh, absolutely everywhere.
Right. But just 1 week later, as we hit late March, what the produce industry calls week 12, they basically vanished. It's as if someone just pulled the plug on an entire agricultural sector overnight.
It was a very sharp drop-off.
It really was. So today we're looking at exactly that. Does Morocco's rapid exit from the European mandarin market represent a structural competitive failure, or is it a calculated, optimal seasonal withdrawal?
I argue that Morocco is suffering from a severe squeezed middle vulnerability.
And I look at that exact same market data and see a highly disciplined, rational market exit by Moroccan exporters. Well, let's examine the mechanics of what's happening to Morocco right now. Their market share dropped to 15.1%, and they're literally disappearing from major European wholesale hubs.
Which is pretty standard for the late season.
I mean, this isn't just a seasonal fade, though. It's a structural trap. Retail shelf space is finite, and the market is polarizing. On one end, you have Spain using sheer volume dominance. They're capturing over 35% of the market with their Nadorcott and Tangold varieties.
Yeah, the volume is massive.
Right, and that volume allows them to absorb price hits that would bankrupt smaller players. Then, on the other end, Israel holds a premium monopoly with their Orri mandarins pulling in, 248 euros per 100 kilos? Morocco is stuck in the middle at 150 euros without the volume to dictate terms or the prestige to command top dollar.
But holding a 15% market share at 150 euros deep into week 12 isn't a failure. It's actually a massive success for Morocco. We have to look at the broader end-of-season dynamics here.
How so?
Well, overall fruit quality naturally declines as the weather warms up, right? And buyer demand weakens strictly to immediate daily needs. If you overstay your welcome in wholesale produce, you get severely punished with devastating price slashing. Morocco exiting now is just a rational strategy to avoid that exact scenario.
Okay, but this isn't just a mandarin problem. It's a fundamental rule of produce logistics. We're seeing this identical mechanism play out in the vegetable sector right now.
With cucumbers, you mean?
Exactly. Spanish cucumbers held dominance all winter, but because they stayed on the market too long, they're facing brutal price reductions from a sudden influx of fresh Dutch and Belgian supplies. Morocco is outflanked in the same way, but from the bottom up.
I'm not sure that comparison holds up.
Well, look at Egypt. They're heavily pushing into the budget tier with their Murcott variety at just 118 euros per 100 kilos. So if you aren't the volume leader like Spain, the premium choice like Israel, or the budget alternative like Egypt, doesn't slipping out the back door early just mask a fundamental lack of competitiveness?
Wait, preserving margins assumes they are fleeing rather than executing a planned withdrawal. Sellers across the board are actively trying to avoid large surpluses as the season enters its final stretch. Why should Moroccan exporters fight a losing battle against the Israeli Orri?
Because they need the market share.
But they can't compete on quality at this specific time. The Orri's organoleptic properties, that perfect late-season balance of high sugar, low acidity, and easy peeling, it makes it vastly more appealing to consumers right now. It commands a 29% price premium over Spanish volume. Morocco withdrawing isn't masking weakness.
So what is it doing then?
It's like a retailer recognizing a shift in fashion seasons. You don't keep winter coats on the rack in April just to discount them to zero, right? You clear the floor to preserve your brand equity and your capital.
The retail analogy is actually really telling, because if we look at historic trajectory data, Germany's total import value for mandarins has been steadily climbing for years, even though the actual tonnage remains stable.
Right. People are paying more for the premium stuff.
Exactly. That mechanism indicates an increasingly premium-focused market. Supermarkets want a cheap budget option to drive foot traffic and a flawless premium option for high-margin buyers. The good enough mid-tier loses its reason to exist.
I think that's oversimplifying the wholesale ecosystem.
Is it? If Morocco relies on this tactical avoidance because their mixed varieties simply can't compete with Israeli Orri's taste profile on the late-season shelf, their mid-tier positioning might not be viable long-term.
See, a wholesale market cannot physically survive on premium Orri and budget Murcott alone. The ecosystem actually requires reliable mid-tier transitions. Wholesale hubs rely on Moroccan supply to anchor the market before the massive pivot to Southern Hemisphere fruits fully takes over.
Like the grapes and pears?
Right, we're already seeing South African pears and table grapes dictating the market pace in their respective categories. Morocco fills a crucial temporal gap in the import calendar. Leaving precisely when that gap closes is strategic precision, not a long-term vulnerability.
Well, we do reach a firm point of convergence there. The European produce market is polarizing sharply. It is increasingly divided between the sheer volume leaders and the premium quality holders.
Definitely.
Yeah, making the middle a remarkably complex, volatile place to operate, especially for Morocco.
The transition seasons always strip away the noise and expose the true underlying strategies of global agricultural supply chains. There's certainly more to explore in how these shifts affect global trade.
There always is. But for now, we leave you to decide. When the lights start to dim on the Mandarin season, is slipping out the back door early a sign of weakness or the ultimate wisdom?